If you like the idea of passive income and living off dividends, you've probably heard about JEPI, otherwise known as the JP Morgan Equity Premium Income ETF. But what exactly is JEPI? How does it pay such insanely high dividends? And under what market conditions does JEPI do well? And when does it do poorly? In this video, we'll break down and demystify the JEPI fund and explain why I am currently adding more shares of JEPI to my holdings. Essentially, JEPI is an index fund made up of over 132 different companies. Many of the companies are well-known blue chip style stocks that are relatively well spread out among various sectors, such as financial, industrial, healthcare, technology, and many more. Many of the individual stock holdings are relatively defensive in nature and pay an above-average dividend. But how does an ETF made up of above-average dividend companies end up paying a mind-blowing monthly dividend payout of roughly 12% annually? Usually, double-digit dividend payouts is an indication of an extremely risky company. So, what's going on? Well, in this case, JEPI is not deriving the majority of its income from corporate earnings in the form of dividends of the stock holdings. Instead, what the fund is doing is earning additional income by trading stock options, which is a more advanced system of trading stocks. In particular, JEPI is writing covered calls. So, in order to understand JEPI's income stream, and understand when the ETF will perform well and when it will do poorly, we first need to understand covered calls. A call option is a contract that gives the buyer of that option the legal right, but not the obligation, to buy shares of the underlying stock at an agreed upon price at any time on or before the expiration date of the contract. So let's say, for example, you own a stock that is worth $100. You might sell a covered call options contract that says the buyer of the contract can buy your shares of the stock at any time within the next 30 days for a price of $110. And for this privilege, the person buying your contract pays you $5 per share that you own. Now you might be thinking to yourself, that doesn't make any sense. Why would someone pay you $5 for the ability to buy shares at more than they are currently worth? But the key to understanding all of this is that the price is higher than the stock is worth right now, but not necessarily higher than what the strike price will be valued 30 days from now when the contract expires. So for example, let's take a quick look at a couple of different scenarios and see how this plays out for both the buyer and the seller of this options contract. So here we are with our initial graph where our stock is currently worth $100 on day one. We are going to sell a covered call contract for $5 that expires in 30 days, and the strike price will be $110. So let's go ahead and add that strike price into our diagram. Now, obviously, during these 30 days, the stock is going to fluctuate in value. It's going to go up, it's going to go down, it's going to do all kinds of things. But let's say that on day 30, the stock price is $109. It doesn't quite make it to the strike price. So in this case, at the end of the 30 days, the stock price is lower than the strike price. So the buyer does not exercise his right to purchase the shares and the contract expires. Remember, the buyer has the right to do it, but he is not obligated to purchase the shares. So with the price currently being $109, he doesn't want to buy it for $110, which is our agreed upon initial price of the contract. So he is simply going to let these contracts expire, at which point we are free to start the process all over again, write a new contract, and find a new buyer for that contract. So what is the math behind all of that? Well, the stock price went up by 9%, from 100 to 109 in that 30-day period. But even though the stock only went up by 9%, we made a 14% profit. $9 from the stock appreciating in value from 100 to 109, And we also made that $5 sale when we sold the contract on day one. So we made 14%. And the buyer, well, unfortunately for the buyer, he lost 100% of his money. He lost the $5 when he bought the contract on day one. So what happens if the stock goes down in value? Well, it's somewhat the same scenario. In this case, the stock price is still lower than the strike price. So once again, the buyer chooses not to exercise his right. He does not buy the shares from us, and the contract simply expires. So overall, what happened? Well, the stock price went down by 10%, and once again, the buyer loses all of his money. He lost his $5 that he put up when he bought that contract from us on day one. But even though the stock price is down by 10%, we only lost 5% of our value. We lost $10 to capital gains when the stock went from being valued at $100. Now it's only worth $90, so we lost $10 there. But we did gain the $5 from the selling of the original contract, so we only lost 5%. Now it's worth pointing out that losing money is never an ideal situation, but we still came out ahead relative to the broader price market for this stock. Remember, the stock went down by 10%, but we only lost 5%, so we did better than the broader market. So what about a third scenario? What if the stock price really jumps, it takes off, and now at the end of 30 days, it's worth a whopping $125? Well, in this case, the stock price is now higher than the strike price, so the buyer exercises his right and he buys those shares from us at the agreed upon strike price of $110 per share. So even though on day 30 it's worth $125, you have no choice but to sell it for $110, because that's what the original contract says that you signed 30 days ago. So what happened? So the stock price went up by 25%, but we only gained 15%. So most people would be very happy with a 15% gain in 30 days. That's still fantastic, but it is important to note we actually underperformed the broader market. That 15% came from $10 in capital gains when our stock price went up from $100 to the $110 that we sold it for when he bought it at the strike price, plus the $5 contract price that we got on day one. So that's how we made our 15%. But in this case, the options buyer, he actually made out like a bandit and he doubled his money. He made $15 in capital gains when he bought an asset that is worth $125, but he only bought it for $110. Minus the $5 contract price that he paid us on day one equals a $10 profit. In general, buying covered calls can be a more risky strategy for the buyer, because if the price of the stock doesn't jump high enough, the buyer risks losing 100% of their money used to purchase the options contract. But if an action is risky for the buyer, that naturally means that it is relatively safe for the seller, since regardless of whether the stock goes up or down in value, the seller is at minimum able to collect revenue from selling the options contract itself. As you can see from the previous examples, when the market is down, flat, or up slightly, writing covered calls is a good way to earn additional income. However, by selling these options contracts, we have effectively put a limit on how much money we can earn in any given time period. Since if the stock jumps in price dramatically, the person who bought the options contract from us gets most of that additional growth, and not us. Given the current challenging economic climate, I feel that it is unlikely that there will be a significant and rapid price increase in these stocks, which is an ideal scenario for a fund such as JEPI, able to capitalize on the relatively flat trend lines. However, when inflation is eventually tamed and interest rates begin to drop again, it is likely that investors will want to jump in and deploy their capital back into the stock market, driving up prices again. And when this surge happens, funds such as JEPI will likely underperform the broad market. For these reasons, I'm currently buying more shares of JEPI, but will likely sell all of them as soon as it appears that the overall market conditions are improving, signaling the start of the next economic boom cycle. So what are your thoughts on JEPI? Are you buying more, or is this fund simply overhyped? Leave a comment down below with your thoughts, and if you enjoyed this video, be sure to subscribe for all of your dividend investing needs. And as always, I'll see you all again next time. Thanks.